For every £1 the UK government earns, it already owes more than £2 in debt. But that's not even the full story.
The latest stats on the cost of government's borrowing show it has risen even above the levels of the short time in office.
The national debt has reached an unwanted landmark, passing £2 trillion for the first time.
Behind the official statistics, the ones you hear on the news or see in budget reports, there's a darker side to Britain's public finances. Hidden debts, off-balance sheet obligations, promises made decades ago that are quietly draining billions every year. And the craziest part is that these aren't debts to foreign powers or shady lenders. They're promises made to you, to British workers, pensioners, students, and even future taxpayers who haven't been born yet. So how did the world's sixth largest economy end up with a hidden debt problem? And what does it mean for your taxes, your mortgage, and the future of public services? Let's break it down. You've probably heard that the UK's national debt stands at around £2.7 trillion, about 97% of GDP. That's the highest level in more than 60 years. But what most people don't realize is that this number doesn't capture the full picture. The official debt only includes what the government directly borrows through things like bonds, what's called gilts. But the UK government also has unofficial liabilities, future promises to pay for things like public sector pensions, long-term private finance deals for hospitals and schools, and even guarantees for energy and housing schemes. When you add those up, the real figure balloons. According to the Office for Budget Responsibility, commonly referred to as OBR, the UK's true liabilities could be more than £5 trillion, nearly double what's on paper. And here's where it gets worrying. Unlike short-term deficits, these hidden debts can't just be cut overnight. They're structural, baked into the system. Let's start with the basics to fully understand how the debt got here. After the 2008 financial crisis, the UK borrowed heavily to rescue banks and restart the economy. Debt rose sharply, from just 36% of GDP before the crash to nearly 65% by 2010. To fix it, the government launched years of austerity, cutting public spending, freezing wages, and delaying infrastructure projects. But while that slowed spending, it also slowed growth. Tax revenues stayed weak, and debt kept rising. Then came Brexit, bringing new uncertainty. Businesses delayed investment, trade barriers increased, and the pound fell, pushing up prices and further stalling growth. By 2019, even before the pandemic, the economy was fragile, and the Treasury was already spending more than it earned. Then COVID-19 hit, and everything changed. The government rolled out £376 billion in emergency support, furlough pay, NHS funding, business loans, and subsidies to keep the country running. To fund it, it issued record levels of new debt. The Bank of England stepped in with quantitative easing, creating new money to buy hundreds of billions in government bonds. It worked, temporarily. The UK avoided mass unemployment and an economic collapse. But that money printing also added fuel to inflation once global prices began to rise. By 2022, inflation hit 11% and interest rates had to surge, making debt far more expensive to service. In the end, the borrowing that saved the economy during the crisis also made it more fragile. The UK is now paying the price for choices made to survive, and the full cost is only just becoming clear. But when inflation returned, the situation flipped. Rising interest rates made debt far more expensive to service. The UK now spends over £110 billion a year just paying interest. That's more than the entire defense budget, and about the same as what's spent on education. The problem isn't just the debt itself, it's who holds it. A growing share is now owned by investors rather than the Bank of England, meaning the government can't simply roll it over at cheap rates anymore. Foreign investors who once saw UK bonds as ultra-safe are becoming cautious. In fact, after the infamous mini-budget of 2022, gilt yields spiked and pension funds nearly collapsed. That was a wake-up call, a reminder that confidence in UK debt can disappear overnight. But there's another layer, the hidden side. Public sector pensions, for example, represent one of the biggest off-balance sheet commitments. The government has promised future payments to millions of retired teachers, civil servants, and NHS workers. These aren't fully funded. They rely on future tax revenues, estimated cost around £2.4 trillion in unfunded obligations. Then there's private finance initiatives. These were deals where private companies built public infrastructure like hospitals or schools, and the government agreed to pay them back over decades. The upfront cost was hidden, but the repayments keep adding up. Billions every year until the 2040s. Add in energy bill guarantees, student loan write-offs, and state pension increases tied to the triple lock, and you start to see the scale of the burden. Even the Bank of England is feeling the heat. It's sitting on hundreds of billions of bonds it bought during quantitative easing. As interest rates rise, the value of those bonds falls, and under a deal with the Treasury, any losses have to be covered by taxpayers. That means we're now paying the Bank of England billions in compensation for losses on bonds it bought to save the economy a decade ago. It's like a credit card where you keep discovering new hidden charges. So why does this matter to you? Because when public debt rises, it squeezes what the government can spend elsewhere. Every pound spent on interest is a pound not spent on hospitals, housing, or climate projects. It also puts pressure on taxes. The government has already frozen tax thresholds, a stealth tax that quietly drags millions into higher tax brackets. By 2028, this fiscal drag could raise an extra £40 billion a year, mostly from middle-income earners. At the same time, Austerity 2.0 is quietly returning. Local councils are cutting services, and departments are being told to find efficiencies. The IMF recently warned that the UK's debt path is unsustainable without fiscal tightening. In plain English, either taxes must rise or spending must fall, or both. But there's a deeper problem: the growth trap. The UK's economy is barely growing. Productivity has stagnated for over a decade, and real wages haven't kept up with inflation. Without strong growth, the only way to manage debt is to squeeze more from taxpayers or cut public investment, which, ironically, makes growth even weaker. It's a vicious cycle. So what happens next? The government faces a delicate balancing act. If it cuts too fast, it risks slowing the economy further, pushing Britain into another period of stagnation. But if it borrows more, markets could lose confidence, raising borrowing costs again. One potential path is reform, tackling inefficiencies, boosting productivity, and targeting spending toward areas that generate long-term returns. Think renewable energy, tech innovation, and upskilling workers. But that takes time and political courage. Meanwhile, for ordinary people, the implications are real. You might see higher taxes, reduced benefits, and slower improvements in public services. Mortgage rates could stay higher for longer. Inflation may ease, but living costs will remain elevated. In short, the hidden debt isn't just a government problem, it's everyone's problem. Because when the state runs out of fiscal room, it's everyday people who pay the price. The UK's finances aren't collapsing, but they're fragile and increasingly dependent on faith. Faith that markets will keep lending at tolerable rates. Faith that taxpayers will keep paying as bills rise. Faith that growth will one day return and make today's numbers look manageable. But faith, as history shows, can evaporate quickly. We've seen how fast confidence can swing. When plans don't add up, borrowing costs jump, and suddenly what looked affordable yesterday becomes a crisis today. That's the danger of living on confidence rather than cash flow. So the next time you hear a politician promise no more borrowing, ask yourself, where's the money really coming from? Because there are only a handful of answers. The first one is to borrow more, which pushes up debt interest and leaves less room for everything else. The next option is to tax more, which raises revenue, but risks choking off spending and investment if you hit the wrong things at the wrong time. The third choice is to inflate it away, a stealth tax that erodes savings and wages, and often forces higher interest rates to fight back. The fourth idea is to sell assets off. But we all know it's a one-off fix that can't be repeated forever. Or a final solution many would consider: cut spending, often quietly, through freezes and delays, which show up later in longer NHS waiting lists, struggling councils, or crumbling infrastructure. And that's why the real debt burden isn't just in the numbers we see. It's in the promises we've made, the systems we've built, and the future we've already spent. Think of the long queue of commitments coming due: an aging population that needs more healthcare and pensions, pay deals to retain teachers and nurses, infrastructure that needs maintenance, and big transitions like energy security and net zero. Many of these are off the balance sheet in the headlines, but they're very real when the bills arrive. So, could higher taxes help? Maybe, but it depends on what you tax, how you design it, and when you do it. Raise the wrong taxes in a slowdown, and you risk shrinking the pie you're trying to slice. Get the design right. Broader bases, fewer loopholes, more certainty, and you can raise money with less damage to growth. There's a world of difference between taxing windfalls versus permanently raising rates, between closing avoidance gaps versus hiking headline rates, between taxing work and investment versus taxing pollution, land, or underused wealth. And that takes us to the big question. Can the UK afford to raise taxes in a slowing economy? What happens to jobs, prices, and investment? Which options raise meaningful revenue without kneecapping growth? That's exactly what we'll unpack in the next video. Now, watch this video next, and subscribe to the channel for more videos about the economy that matter to you.